We've got Rowan Williams from Nitrogen Fund Managers and Wayne McCurry from Momentum Wealth in studio. We were chatting about Lewis just before the break, Wayne, and Rowan deems it a good buy. What are your thoughts on the business?
Well, look, the market certainly liked the results that came out. I mean, you can delve into the results and have a good look. It is by and large a bad debt provision that's been written back. So the underlying operations are not performing as well as what the headline earnings look like. But of course, I mean, it is a legitimate, it's legitimate transaction to reverse part of your debts provision. We've got to think a little bit, you know, are the debts still high enough for the current environment, etc., etc. But I actually agree. I think Lewis is actually quite a cheap share. I mean, the PE is very, very
and
low.
We're talking about a dividend yield of 10%.
Yeah, that's very low. So I would take it, but you know, unfortunately, the market's not always as logical as a person who analyzes shares. And when the market turns its back against a sector or smiles on a sector, it'll either go down a lot more than what you expect or go up a lot more. But I think Lewis is okay. It's not a micro lender. They have got more to their business than just advancing finance. So yeah, but you might have to be patient. But certainly the market liked today's results.
Ron, you wanted to add to that? Sorry. It looked as though
yeah, well, interesting. I've mentioned before, we look at relative value. So if you look at, say you were long Lewis and short Abel, and if you actually look at the underlying metrics, and I think people used to own Abel because of its dividend yield, and now that's clearly almost disappeared. I think at the current valuation, the current share price, it's on a 3% dividend yield, whereas Lewis is on a 9 or 10% dividend yield. So if you look at that, that's at current, that's after the movement that you've had, which is, we looked at it today, it's a 50% movement, relative movement this month in share price. So you could have done very well by saying being long Lewis and short Abel, and where they in similar, sort of have similar business dynamics.
Wayne, I wanted to get your just your impression on what actually transpired with African Bank. Obviously this nasty trading update came, and then it was followed by the results which told the market that the dividend was getting cut 70%. Why do you think the markets reacted so violently to Abel?
Okay, look, Abel gave a trading update a couple of months ago where they said things were okay. I mean, obviously they all said, you know, trading conditions tough, you know, but everyone's saying that, you know, consumer under pressure and all of this, but they didn't mention any major issues in their books. Then they came up with the trading update and the market was not expecting it, so it pounded the share. Then they came up with the explanation of the trading update, which I'm not sure helped.
I don't think it did, no.
No, I don't think it helped, because that's the first time
it just made matters worse.
Yeah, that's the first time I've seen when you give a trading update, then you give a trading update on the trading update. So that in itself tells you that
they perhaps need a new investor relations person.
It's possible. Then they came up with the results, and the big thing in the results was cutting a dividend. Now the market would have said, well, you gave a trading update, you gave an explanation to the trading update. Why didn't you tell us you're cutting the dividend by 70%? And in investments, if you've got bad news, get it all out there at the same time. Don't think dribbling out the bad. Don't dribble out the bad news. Dribble out good news maybe, but don't dribble out bad news. If you've got bad news to tell the market, get it out there in total as quickly as possible. Now, is Abel after this dramatic fall a buy or not? Look, I'm worried, and I have been for a long time, about the microloan, the unsecured loan business. It's gone ex-growth, it's had its glory days. It doesn't mean you can't make money out of it, but I think with such a negative perception on a share, even if the next results are good, the market's just going to be skeptical. So I think sit back and wait on this one, no matter how much it might offer longer term value.
Wayne, I want to get Rowan in here. Just on Abel, you've mentioned the dividend yield now around 3%, a big change, and obviously, you know, the sell-off warranted because of the continual surprise on the downside for the market. But you're a value man. So, you know, you've got to say, if you're finding value in Lewis, is it because Abel is not well run? It's got the same traction on an Illerines or not?
Well, so let's look at it. We looked at the numbers this morning. In terms of Lewis's results this morning and Abel's results last week or whenever, even after this 10% increase, Lewis is still a lot cheaper than Abel. So why would you buy Abel when you can buy Lewis, which is still cheaper and clearly is better run and, you know, manages expectations, market expectations a lot better, etc. And there's so much, I agree with Wayne, so much residual risk inside Abel in terms of that micro-lending book. And clearly they have indicated in their results that their massive expansion in the last 2 years has basically been a mistake. And they sort of ran amok with lending basically. And now they're having to scale back that risk. And so what is the tail of that risk? And what impact does that loss of confidence have on their funding model, even at the very least the cost of funding? And I think in terms of the market reaction, not unwarranted.
Just to obviously invert that, Ron, and this is the point Sam Hooley made to me yesterday. If Abel's price now reflects all the risks in the unsecured market, do you not then have to turn to other players in that market, like perhaps Capitec, and say that share price has got to come down? And as a hedge fund manager, you can bet against the short. You can bet on the short as well. So what does it say for Capitec and the other players in the unsecured credit market?
So this is what's been quite difficult to say. How much of the problems are unique to ABEL, to African Bank, and how much of them are industry-wide? Because if we look today and what happened, Lewis's results were completely opposite to what African banks were. The dividend up 14% or whatever the case, earnings up 14%. And then you saw some of the credit retailers, which have been going down last week, start to move up. So we're not sure. So the likes of Truworths, Foschini, Capitec, I guess, were they much more responsible in their lending? Did they stick to their business model and their knitting? You haven't seen the same kind of massive expansion in unsecured lending, or the massive, at least in the sort of clothing credit retailer books. Okay, Capitec's a different story, but as they keep pointing out, they're much more transactional banking as well. So time will tell, but I'd say there has to be some contagion with some of the other lenders.
When earlier in the discussion we put to Rowan, or we asked him whether if we took 50% of current prices on the platinum stocks, would he go in and buy? I'm not going to tell you what his answer is. I want to know what your answer is. We take 50% of current platinum stock
I'll
prices.
answer that in a slightly roundabout way. It all depends on who your clients are. If you got clients who believe in your investment philosophy and they trust you that you will handle their money well, and they're not short-term investors, I'll probably buy the shares now, because I believe there is a very good future for platinum, and the current woes in the industry are in fact cyclical. I don't think they're structural woes. Demand is low, supply, there's just too much around. There's nothing wrong with the underlying demand for platinum. So to answer the question, if they have to halve, I would definitely buy them. But as I said earlier on, when the market hates something, it just hates it. And so I don't think the shares could go down. Now contrary to that, not that many years ago, platinum was the go-go. Everyone was listing platinum, and the PEs were horrendous. The PEs were in their 40s. And they were just massively expensive. Now the index is roughly 1/3 of what it was. I actually think it represents long-term value, but you're not going to make money for the next year, I wouldn't think.